So now we're going to look at calculating the break-even point and looking at sales necessary to achieve a target profit. So a break-even point is the point where revenue and costs are the same. You're breaking even. So it's good in business planning when you're looking at increasing or decreasing your operation. So if you're at a point where you're making money selling 100,000 units and you're thinking of scaling back to 70,000, but say your break-even point is 80,000 units, and anything below 80,000 you'd be losing money, well, you know that you don't want to decrease your operation that much. So the break-even point, so if we look at our selling price per unit of $25, our variable cost per unit of $15 gets us our contribution margin per unit of $10. And then our fixed costs are $90,000. So if we want to calculate our break-even sales, so we take our total fixed costs divided by our unit contribution margin. So our fixed costs are $90,000, our unit contribution margin is $10, so our break-even point is 9,000 units. So let's look at our income statement. Our sales, 9,000 units times 25 bucks. Variable cost gets us our contribution at 90,000. We subtract our fixed cost of 90,000. So our income from operation comes out to 0, which means we broke even. So if fixed costs increase, then the break-even point in units increases. If fixed costs we think are going to decrease, then the break-even units decreases. So let's just say, how would a $100,000 increase in fixed costs affect the break-even sales units? So let's look at it. Our selling price will be the same, contribution margin's the same, our fixed costs increase, so our break-even units increase by $5,000 a unit. So fixed costs increase, break-even units increases. So now our new calculation is $600,000 fixed costs divided by $20 unit contribution margin, 30,000 break even. If we increase our fixed cost to 700,000 and we do the calculation again, 700,000 fixed costs over $20 unit contribution margin gets us our break even to 35,000 units. So we have to sell more units to break even when our fixed costs go up. So now let's look at the changes in variable costs. If we think our variable cost per unit will go up, then our break-even units go up. If our variable cost per unit we think will go down, then our break-even number of units go down. So there is a direct relationship. So if we think our variable cost per unit will increase by 2%, let's look at the impact on break-even sales. So now we have our fixed cost of $840,000 divided by our unit contribution margin of $105,000, and it would take 8,000 units to break even. If we increase our variable cost per unit by 2%, that brings our contribution margin per unit down to 100 under proposed. So if we take our fixed cost of $840,000 divided by $100 unit contribution margin, now our break-even units goes up to 8,400. So variable cost per unit goes up, break-even units go up. So now let's look at selling price. If per unit selling price goes up, then break-even units goes down. If unit selling price goes down, then break-even units goes up. So there's an inverse relationship between these two. So let's look at a $10 price increase in the effect on the break-even sales units. So as it is now, our unit contribution margin is $20 per unit. So if we divide our fixed cost $600,000 divided by $20 unit contribution margin, it'll take us 30,000 units to break even. Under proposed, we have our $600,000 fixed cost, but our unit contribution margin goes up to $30. Now it will only take us 20,000 units to break even. So when selling price goes up, break even units goes down. So target profit. So if we want to find the number of units to attain a certain target, we're going to add the target cost to the fixed target profit to the fixed cost in our break-even formula. So to calculate our break-even units, we'll take fixed cost plus target profit over unit contribution margin. So under this scenario, if we want our target profit to be $100,000, and we do our formula, so we'll take our $200,000 fixed cost plus our $100,000 target profit, divide that by our $30 contribution margin per unit, and we find that it'll take 10,000 units to achieve our target profit of $100,000. So let's verify. Let's put our income statement together. So if we sell 10,000 units, we take our revenue, our variable cost, and we get our contribution margin of $300,000, subtract our fixed cost of $200,000, and we get our target profit of $100,000.